how both of you guys, and I'll share mine as well, but how Compound and UMA came to be, and how things have just changed so much since the early inceptions, because there is this kind of changing environment of DeFi, but Compound in particular and UMA shortly after, you guys were pretty much trailblazing what it is, what DeFi is today. So I'd love to hear your stories about the inception.
Yeah, Robert, you existed before DeFi was a word, right?
Yeah, that's true. So I guess I'll go first. I mean, so, it was 2017. It was the middle of the sort of ICO boom. And I sort of looked around at the space, and everybody was using smart contracts to create tokens and to come up with like token sale contracts. And nobody was using smart contracts to build really interesting financial applications and markets. Like literally at that time, like the only cool smart contracts that existed were like 0x, non-custodial trades, right? And aside from that, there was like basically nothing. And looking at the space, I was sort of shocked because smart contracts are crazy powerful, and nobody's really exploring what you could build with them in terms of like creating like really interesting financial markets. And so, I basically decided then and there that, I was going to build something with smart contracts that you couldn't build without them. And looking at the space, the most obvious thing was like, oh, why don't we use smart contracts to create interest rates? And why was that necessary? Well, because crypto is irreversible and it settles permanently, it's really hard to send someone crypto and hope to get it back, right? Whereas you can send someone money and it's very easy to get it back. Sending someone crypto, there's no way you're getting it back unless there's a smart contract or you really know each other. And so it seemed like a really ideal application that you couldn't really build through centralized services very well due to the trust factor. And so this was before DeFi was a phrase, and we basically got to work saying, well, let's build a completely autonomous market for people to earn an interest rate and borrow assets. And it was a lot harder than it seemed because there was very few sort of like functional systems running in 2017. It took months of sort of just pure R&D to even discover what was possible using smart contracts before we, proved that something like Compound was possible. We released a prototype in like early 2018 and then shipped the first version sort of like later in 2018 and like late summer. And that was right around the same time exactly that the phrase DeFi was sort of created. It wasn't created by us by any stretch. But that was like the sort of like beginning of sort of decentralized finance, fully autonomous markets. MakerDAO was sort of, our predecessor in a few ways. Like they, Psy, which used to be called DAI, but Psy was sort of, early 2018 as well. And DeFi back then was like, 5 projects. It was kind of a crazy time.
And Robert, you're like a finance nerd too, right? You've always been a finance nerd, or did you come to be a finance nerd doing more of this DeFi stuff?
No, I was a finance nerd before DeFi. And so I really wanted to do finance on a blockchain. I was one of like the 5 people that thought that was cool.
Well, Rob, what was happening? What were you doing before 2007? What was like 2015, 14? What did that look like for you?
Yeah, so from 2007 to 2011, which was kind of like a dark age on Wall Street, I was working in interest rates, both in the sort of like analysis and modeling side. And after that, I sort of left finance and became a software founder, moved out to California, did this, Silicon Valley startup world. And, Ethereum and smart contracts brought those 2 things together where I was like, oh, wow, like you can program money. Like that's incredibly powerful. What can we build now that we can program money?
Interesting.
Yeah. Finance nerd. But yeah, and Robert, I was trading interest rates from 2005 to 2013, which, so co-finance nerds. Chris, you were never a finance nerd though. You've always been like a cool e-commerce guy, right?
Prior to that, I was a bodybuilder, interesting enough. But I was never a finance guy. I actually spent most of my early career in tech sales, hardware, software, like big, Cisco and Microsoft, VMware type stuff. And I was doing that in New York. And then that was where I actually found Bitcoin, because my office was right on top of the original Bitcoin Center on Wall Street. So I kind of got lucky. And I had a buddy of mine that moved to New York as well from Toronto. And he was just like, dude, you got to come down here. You got to, buy some Bitcoin. We used to buy Bitcoin off of a guy that was managing like an auction with an Excel spreadsheet as the order book, wearing a bow tie. Like, it was pretty funny stuff. But yeah, like most of my time was spent in sales. And then I got into e-commerce and online marketing with a couple businesses that I started in 2015 through 14 through 16. And then I just pretty much spent the rest of my time in crypto.
Wait, Rob, what year, or Chris, what year was this about the Bitcoin Center on Wall Street? Is this like 13?
Yeah, 13, 14.
That's fucking wild, man.
Mm-hmm.
Yeah, you're OG.
Yeah.
I guess I just, bought and hold Bitcoin. I don't know how old that is, but I still have the Bitcoin that I bought then, interesting enough, which is great. But yeah, it's just the journey. I think for a lot of folks is different, for me, and that's what kind of led to Badger. But it was like, I've always been a believer in Rob. I think you had a little bit of a debate with Brad on one of our poker games. Hart, you might have been there too a few months ago, but it was like, I've always believed Bitcoin to be, the premier collateral, right? The best hard money ever invented. And that has nothing to do with, the permissionless platforms like Ethereum. But a lot of people are always doing this Bitcoin versus Ethereum, Like this tribalism is just so ridiculous, right? And that's, I was never on that side. I've always been a big fan of ETH. I've always been a big fan of Bitcoin, because they're independently amazing in their own rights. And just to see, I actually argue nowadays it's actually not as toxic as it was maybe a couple years ago amongst the communities, but that in itself has changed quite a bit over the years. But I'm happy to see it at least now.
Yeah, I mean, it still feels a little bit, adversarial, just because I think, I think it sort of like stems from Bitcoin in that, it is an asset that is created through social consensus, and it has value because people believe it has value, and it's useful because people believe that it's valuable. And so, it makes sense to sort of, try to convince everyone that it's the only important asset, so that all capital flows into Bitcoin so that its chance of success is highest, right? Because it needs that, social consensus. And I think the reason why, Bitcoiners are antagonistic to things that aren't Bitcoin, they also have good reason to be, probably dating from the, 2013 to 2016 era, where everything that wasn't Bitcoin, like, really was just, a tacky attempt before there was anything useful that's not Bitcoin in a lot of ways. And so, I can see the history there and why they're so, skeptical of things that aren't Bitcoin, even when super useful stuff like Ethereum has proven that there's more than just Bitcoin.
Yeah, but Rob, we're also in this age of tribalism, right? So it does kind of make sense, like you said. But Chris, you found a way to bridge the gap, right? Like, Badger does seem to be. Give me the latest on what Bitcoiners think of what Badger's doing. They're like mostly pro it these days, right?
No.
Sorry.
If you talk to like hardcore Bitcoiners about Badger, like they're just like, oh, it's ETH, it's centralized shit. Like, that's just how they talk, right? It's just ridiculous, So no, that's by no means our target audience today, or at least the users of Badger today. That's where we hope to get to over time, But for the most part, the people that use our protocol are heavy, DeFi power users that want exposure to Bitcoin and also want to put that Bitcoin to work and don't want to just leave it in a hardware wallet doing nothing.
Yeah, well, I think there's something to be said about the power of yield here, right? Like, the idea to have, I think the people in Badger, people that have Bitcoin and are seeing all their DeFi friends put assets to work and actually earn more, I mean, that's pretty attractive, right? And that's been a good amount of your users who want to do something productive with their Bitcoin, right?
Yeah, totally. Right. That's, you know, that's the whole thing. And I believe over time, more and more, I believe, you know, I don't know what the time frame is, but upwards of 50% of all Bitcoin will live, maybe 50 cents a bit much, but like 40% of all Bitcoin will live on other chains and be used on other chains and made productive. And I don't necessarily see much of that productivity coming on the Bitcoin network. And that's not a bad thing, right? Like the interoperability and the composability cross-chain is going to be very valuable and make Bitcoin even more valuable because it brings additional utility. It's going to take, you know, it's going to take time to get there, but I believe it's going to get there.
Yeah, if you can make it not a pet rock and you can make it something useful, you know, it's better for everybody.
Yeah, most certainly. Well, Hart, like what's been your story? I don't know as much about your story as I'd like to, but I'd like to learn more about it. Pre like crypto.
Yeah, so I'm Canadian, like you, man. I went to high school in Toronto. I went to college in the States, and I graduated and worked on Wall Street for 8 years, trading interest rates. So doing the finance nerd thing, like Robert. But I traded interest rates at Goldman Sachs, and it was a weird job, man. It was really, really interesting, and I learned a ton of stuff that I didn't know because I didn't come from that background. I was like a computer science nerd in college. And that gave me lots of finance exposure. All kinds of shit that I like I was literally the guy at Goldman selling bonds to the Fed when they were buying them through the financial crisis. That was kind of fun. And then I did this fintech startup following that. And in early 2018, late 2017, I got pulled back into crypto. And kind of like what Robert said, I think Ethereum's primary use case is finance. And that was sort of my thesis from early on, that it just smart contracts plus money, building an automated programmable way of moving financial risk and moving money through smart contracts made all the sense in the world. And I was like, nobody's building derivatives or building ways to program financial contracts on Ethereum. And that's what drew me into the space back then.
And then how did UMA come to be?
So the original idea, I think, is just being kind of nerdy here. A derivative contract, like a traditional derivative contract, is this financial contract between two counterparties, and it's secured with margin that's like cash money you move around. But in the traditional banking system, it takes you like at least a day to move that money around. And it's really clunky. It works pretty well, but it only works pretty well at massive size. And I was really attracted to this idea of using smart contracts to create derivatives with continuous real-time margining. So I'm being like super nerdy here, but the idea is if you could move money really quickly, you could secure a derivative contract with a small amount of margin because you keep moving those margin payments really quickly. And in theory, something like a blockchain like Ethereum could be a really beautiful way to do that. And this would let anybody write derivative contracts without legal recourse. And this would be a really powerful, wild way to effectively create a protocol for risk, like move financial risk across the world to anyone that had access to the internet and digital money. And that seemed like a pretty good thing to try to build, and seemed pretty fun. So that's kind of like the origin story, if you will.
And did you guys raise money? Like, this is an interesting conversation for me because, you know, some people know, but, you know, BADGER launched a few months ago without raising $1. And like, you know, we're completely intended to be a community-run project and initiative, you know, a headless type organization, as Andre will call it. But it's very different from how some of the and they call them younger DeFi projects, meanwhile like a year prior, but some of the projects came to be. So for you guys, did you go down more of a traditional route, and how was that experience?
Yeah, so I'll start. So, when we were creating Compound, we had no idea if there was ever going to be demand for what we now call DeFi. You have to appreciate that this was 2017, 2018. And, we were building completely untested systems, right? Like DeFi really did not exist yet. Like when I was asked what the market size was, I said, today it's basically $0, but eventually it's trillions of dollars. And I had, one, no idea how long it would take before there would be market demand. In some cases, I thought it might be like 5 years. And two, most of the sort of like development activity and speed that happens now when people are like launching products occurs because, there's already lots of templates out there. There's lots of projects that have like figured out a lot of, very basic building blocks for creating smart contracts and creating, autonomous, products. But back in this day, there was really no libraries or existing contracts that you could copy, that you could copy paste from, that you could, learn from. So everything we were doing, we had to basically discover for the first time for the industry. And so for us, it was a no-brainer that we had to raise. There was literally no way we could have shipped, Compound in 2018 and had, one, a market, two, users, and three, like a means of like survival. And so we raised venture capital money. Our seed round was like $8 million or so. And it's because we thought it might take years to be able to ship Compound. And, for us, we wanted to plan to like have more capital than we needed, mostly because everything we were doing was completely unproven. It was possible that, we'd be sitting around building for years. And so that was sort of how we financed the business, put a team together and sort of underwrote the initial development. And that was, I think, completely necessary at the time. It's less necessary in 2021 because a lot of the heavy lifting has been done. At this point, I don't want to say it's easy to deploy a protocol, but, you're not solving problems for the first time. You're kind of dragging and dropping a lot of ideas that other people have created for the most part in new and exciting ways. So it's not like 6 months of R&D to build something. People are launching products with 2 weeks of engineering. It's crazy. And so I think teams nowadays don't need, to have 5 engineers working for a year to be able to ship something. A lot of teams now have like 2 people and they ship something in a couple of weeks, and there's a lot smaller hurdle to going live. And so there's less need for capital. But back in 2018, I mean, it was capital or death, And so we went the route of raising money.
Well, was it hard to raise money, Rob, then? Like, because that was a weird time. Like, when was that? Like, late 2018 or right before, the ICO, craze destroyed the market?
Yeah, it was like March 2018. And it was a really funny time because, like, Bitcoin hit its highs like a couple months earlier. Ether hit its highs a little before that, but was starting to crash. I mean, it was a time where crypto was cooling off and ICOs were over, like just flat out over. Like you'd get sort of like ridiculed a little bit if in March you were pitching an ICO, And so it was like the beginnings of crypto winter. And that was sort of like what set off, a pretty long period of building. But, March 2018 was still like a pretty good time to raise because like there was still a lot of like enthusiasm. Like, the highs were only a couple months ago. And a lot of days we thought like we made it through the door before it closed. And after that, it got a lot harder. $8 million seed rounds. We were kind of one of the last ones of that sort of generation. And after that, it got pretty hard for teams to put together capital to be able to build.
Yeah, you were right in that window. Like it was that March. It was like March to consensus. I remember I was at consensus that year, and like the market peaked back up from like a big dip to like 400 or 500 million or something, a billion or something. And I remember people were on fire again with like raising and some ICO stuff right around consensus. But after that, like it was that 3-month window, and then it was just a death spiral.
Yeah, then it was winter. It was like a true, like you had very little. Most teams had very little capital and resources, and they had to build with nothing, and that was hard. And we felt extremely lucky, and that we made the right choice.
Yeah, I totally agree with you, Rob. I think, it's, and I'll speak from, just our level of experience. It's one thing to point, like one thing I don't like that I see some groups do, kind of like they point and say like VC investment, that type of stuff's bad, that's stupid. It's like that's actually like their marketing pitch, something along those lines, as if like, that's a bad thing. Like it's not. There's different ways to do things, but like the way that protocols can trailblaze and bootstrap, really it's a bootstrapping activity, leveraging things like liquidity mining and things along those lines to take products to market, to take their business to market, is very unique and is not possible without the underlying templates that you speak of, right? If it's synthetic, like how many governance modules are built off of Compound, or staking contracts are built off of synthetics, right? Like that's kind of part of so much of what exists today. And I think people that look at it negatively are really short-sighted. And it's more around the lines of the opportunities for bootstrapping have changed tremendously now, and actually, and I believe it's just going to change the whole way businesses go to market, forever now. Like this in itself, and many people don't talk about this, but like this is a whole new playbook for taking businesses to market and accelerating at growth that you could never imagine. And we're going to continue to see a lot of this, but it definitely was a different time, and people that don't tend to respect the differences, I feel, are short-sighted.
Yeah, well, I mean,
I'd add one other thing, Chris, which is like when Rob was raising money and we raised money after him, tokens were actually evil. Like they were literally evil. People like yelled at you if you had a token or contemplated a token back then. And like Robert, you raised money without saying you're going to have any token, if I remember.
Yep.
And like DYDX and like Dharma kind of were in that era, I think. It's actually one of the things. We raised money, $4 million seed round in June of that year, but we actually did the thing where we said we were going to have a token. We said like we think the point of crypto is these tokens can align incentives, can do powerful things. And again, going back to your point, like the market changed. Now you can use a token to bootstrap your product and to actually like it's a really creative and interesting fundraising mechanism. But in 2018, it was like evil, and you couldn't do that following the ICO boom. And one of the things, if you want like a prediction, I don't like this, but I could see if we cycle too high in this run right now, I could see us like maybe it's like 2022 that people are anti-token again if bad things happen through this cycle. Might be interesting to see.
Yeah, I mean, well, going back to the purpose of venture capital, I mean, venture capital is really good at one thing, and that's underwriting risk for long periods of time, right? There's very few other market participants that are willing to provide capital for teams to figure things out over years, not weeks or months, right? And that is the one thing they do extremely well. And it, when done correctly, it gives teams the opportunity to figure out things over market cycles, right? Not to have to figure things out immediately, to sort of wait and see how the world unfolds. And I think that's really valuable.
And Robert, like to your credit, you've been very consistent around that view. Like I actually remember taking a call with you because I was introduced. We had a common seed investor. I remember being introduced to you by this investor, and I remember being in my dad's backyard and you telling me exactly this. You're like, I'm taking more money than I need because I don't know what the cycle is going to be and it's scary. You were actually very consistent on this, to your credit.
Yeah, and I actually got that advice way back in the day from Brian at Coinbase, who said, yeah, we raise, to get through the next market cycle, and we raise enough capital that, knowing that there's going to be massive bear markets, time to figure things out and to, solve whatever problems like occur along the way. And I think in crypto, that's super valuable. Having a little bit more money than you think you need, knowing that things might take a lot longer. And sometimes you get lucky, right? And things happen sooner than you anticipated. But we had what I was thinking was going to be like 4 years of runway, knowing that there wasn't even a phrase called DeFi, right? And it might take 4 years before people would want to use smart contracts to do finance stuff. And it just so happened that it started to pick up relatively quickly. And by 2019, just a year later, people were using these things in increasing scales, and it was a market that was growing roughly like 30x a year, right, at Compound, which are kind of crazy numbers. The first year we had like 10, $15 million of assets in the protocol. By the next year we had, 50. By the next year we were in the hundreds, and right now it's at 9 billion, right? It grew much faster than anyone would have imagined, like even plausibly. And, maybe we could have gotten by with way less capital, right? But I think, sometimes you're better off, just partnering with folks that are thinking in years, not months.
Yeah, I think one of the things that's interesting to me, and Rob, we talked about this a while ago, just really loosely, but one of the things I've always thought about, it was, it speaks to like the difference in capital in the system, and how nowadays capital accelerates so quickly, right? And yeah, you're building off of more battle tested code base. But like, as we see many times again, one small change could, break the castle, right? So it's code that, for the most part, the people that are building on top are not nearly as familiar as the creators. But, when you talk about going from 15 to 50 to 200 to 9 billion, there's obviously a difference in how kind of you manage the security posture, the protocol, and all these types of things when you're not seeing, 100 or 500 or 1,000x growth in capital within days, if not weeks. Like, how do you both look at that? Because I know it was kind of a slower move for both of you guys, but how do you see that versus some of the explosion that you've also experienced in the recent times, but as it contrasts to newer protocols that are getting ready to launch or that have launched and that have seen that growth and had to build a security posture extremely quickly?
Well, when we started, by the way, like no one even was convinced that smart contracts were safe enough to use. If you think about the history here, I got sort of my eyes open towards Ethereum and building things with smart contracts when the DAO was hacked and Ethereum forked into Ethereum and Ethereum Classic. That was a really bright memory in my mind. After that, the Parity multi-sig wallet, which was like the equivalent of today's Gnosis multisig. I mean, it was like the multisig wallet that everybody used, had 2 hacks, both of which led to hundreds of millions of dollars of losses. And that was sort of the backdrop for when we were starting Compound. Almost everyone I talked to at the very outset wasn't convinced that smart contracts were safe. I used to like pitch Compound. And I used to say, well, if they're built correctly, a smart contract can be safer than a centralized business. And a lot of people laughed and didn't take that seriously. They said, no, that's not true. These things are constantly like having disasters. You can't rely on them. And it was the mindset that this was unsafe until proven otherwise. And that was our mindset too. And so, we spent, close to a year before we launched. By the time we launched, we had multiple audits. We took everything, with an extreme skepticism because we didn't believe that it could be done safely because no one else believed it could be done safely. And, in a lot of ways, security and decentralization are at opposite ends of the spectrum. The safest thing early on is for a team to have complete control over the code base, in my mind, to be able to react to bugs and crises and unknown situations. And, because you have to assume that things don't work. Teams today have the ability to take a lot of this stuff for granted. other teams have proven that smart contracts can be safe. They can work. They can be reliable. Obviously, people's standards have lowered over time, and I think there's a lot of reasons for that. But at this point now, people understand that it is possible for this to be done safely without a smart contract bug. And it's a complete evolution of the mindset. And I think teams today are better off, but they don't always, show that. They take it for granted sometimes. And you see this again and again, where there's just waves of projects and every single one of them, quote, gets hacked and loses money. And it's considered to be okay because everyone goes into that with their eyes open, that everyone's moving fast and having fun and yada, yada, yada. I don't think that's necessarily a great approach, but at least nowadays teams are pretty transparent that they test and prod and that there's going to be spectacular failures.
It just seems, Rob, like there's just multiple approaches now. Like your approach was, I think, the go-to de facto approach of your era, right? Where you're going to raise a bunch of money from Andreessen Horowitz and you've got all this other stuff. You can't move fast and break shit and lose a bunch of people's money. It's not really acceptable, but other teams feel differently and they don't, it's just a kind of a different beast. So it seems, Chris, like there's just more than one way to do this right now. There are teams out there that are totally comfortable running an experiment, knowing that it might not work. And there is something really cool about that, to be able to run economic experiments and see what happens. It's just also scary and at worst verges on irresponsible, right?
Yeah, well, I think, to Rob's point, I don't know if they had a choice, right? If you're that confident that the smart contracts you're building are going to work because no one's ever done it before, and it doesn't sound like anyone had confidence that you'd be able to do it, and it takes a year. That's much different from everybody obviously assuming these things are going to work, because it has worked, and it's worked to the tune of billions of dollars for a few years, or a year and a bit plus. So I do think it's a very different time. I think a lot of it, not uncommon from business and entrepreneurship in general, but a lot of it comes down to the character, integrity, and the value and belief system of the people behind the business too, right? When you talk about these grand experiments that people are doing, a lot of the times, for whatever reasons, this is not a knock, but people hide behind anonymity, and many of the times it feels like, and I'm not speaking about any group in particular, but it feels like it's kind of a quick thing to make a quick buck. Let's call a spade. How much bullshit rug pulls are there all the time from people that promise a bunch of stuff and then just steal a bunch of money from people, right? Those are think about someone that would do that, right? As an individual, and the character and morale of that individual, and how off that is from what we're all out there to try and do and build and have a real impact on the space around.
Greed's a powerful force, man. But I agree with you, Chris. It's not the way, I think your mom would be proud. It's not the way she raised you, and it's not the way you're going to act. But
are you about my mom here, Hart? Is this what
don't bring her into this, Hart.
Don't bring my mother into this.
Your mom's a saint, man. I'm sure she's a lovely, lovely lady. We'll go good, yeah. But no, man. I mean, your mom should be proud. She's got a nice, she's got a son that's doing crazy shit in DeFi and in crypto. And
say that to her, DeFi. She'd be like, "What the fuck is that?" Mom's first generation Canadian from Italy. She's in the fucking DeFi. Oh my goodness, that's funny, man. That's funny. But times are different. It's just, it is what it is as it relates to what it was like to build then. Even for us, we just launched 3 months ago. I can't even believe that. It feels like it's been fucking a decade, just the trenches that we've been through. And we built our code base primarily off of Yearn V1 vaults, right? That was where our product code base, and, we built some optimizations around it, and we built our own kind of reward and staking mechanism, which was a massive lift for us. But, we also spent the time prior to launch through peer review, through audits, and we did all that type of stuff for the purpose of we're not going to put, even if this has been battle tested and it's been audited a bunch of times, and there's already been hundreds of millions of dollars in a protocol like this. Like, we can't just go to market. It's just not the way to do it. We have to make sure that all the pieces kind of work together, and also give us time to get as familiar as humanly possible with the code base that we're bringing forward in the system. And that, we finished building, I think it was August range, and we didn't launch till December. And it was kind of just going through a lot of that process, and timing ended up working out just because there was a little bit of the DeFi summer burnout, and then getting ready for the Christmas time. But in general, like, that's I talked to quite a few folks that have either recently launched or are about to launch, and it's like, do everything, like, call it what it is, call what you're building what it is, and do everything you can to protect the most likely inevitable huge influx of capital that's going to come into your system. Like, just recognize that immediately, that it's probably going to happen, and know that it's going to throw you for a massive loop, and it's going to be unbelievably stressful and difficult to manage. But at the same time, like, your number one responsibility is protecting those users' funds and the integrity of the system. So what can you do to help do that? There's a lot of things, right? Like, because the space has matured, like, even certain coverage, protection, or whatever you want to call them, insurance protocols, like, incentivize the shit out of that. So in case something does happen, make sure that their asses are covered, right? Make sure you use whatever incentives you can provide to drive people to go get that protection. And Rob, to your point earlier, and we got a lot of shit for this at BADGER, but we kept as much control as we could for the purpose of agility around the contracts that we put into the market. People were saying, hey, throw a time lock on that. Hey, you need to do all these different things. You should have, a 7 of 9, and all the signers should be public. And, people just kept going on and on around, the governance and the management and upgradability of the contracts. But, like you said, and I'll agree with it, and I'll echo it. When protocols are launching, I feel like the best way to protect users' funds and protect the potential disaster situation is to have as much control as you can, with the intention and plan towards slowly decentralizing. And that, I hope more and more people think that way. And also, like I said, incentivize that protection and coverage day one for their users, if that's something that they can do.
Chris, like, that works, right? But it goes back to your earlier point. As long as the team you're trusting here at launch is credible. And it's interesting because I think that really doesn't work if that team is anonymous or unknown. You actually need to go the other route, where you can't give them that same trust you would to a credible known team. Do you agree with that, or no?
Well, I don't know. That's a hard one, right? Because, like, look, well, I was going to say, look at sushi, but look what happened with sushi too, right? Like, in those first
They're both examples, right?
It's kind of both, right? Like, there's certain people with certain, certain belief systems that were starting it. It was Sushi Chef at the time, and then you obviously had Mackie. But, it was the anonymity that gave the confidence for Sushi Chef to take the funds, or not take the funds, but cash out. And if they weren't anonymous, would that probably have not happened? I don't know, right? But, I would say more times than not, Hart, the anonymous groups would be less trustworthy than the non-anonymous groups, I would say.
Yeah.
I don't know. What do you think, Rob?
Well, I think it, at the beginning, before you've decentralized something and it runs completely autonomously or through like an extremely large distributed group where you can't get rugged, so to speak, in the early days, I think a lot of projects do work best if, when you're using code that's never flown before and things can go wrong at a moment's notice, having the ability to pull the emergency cord. And it does rely on the sort of reputation of the developers that, they have, that they're not going to do anything malicious. Now, I don't think many people should trust, a system with a large amount of funds or a large amount of their own funds before, protections are in place. And I think, any system shouldn't scale, prematurely. But I do think reputation is a strong deterrent, and reputation includes the people involved, the people supporting them, et cetera. Like when everyone knows the identity of somebody, it's a lot less likely in my mind that they're going to deliberately rug somebody. Most of the situations we see are with anonymous founders. The worst possible combination is anonymous founders or team and no restrictions on their ability to act. That's a terrible combination. But I think a known team and low restrictions early on with low amounts of capital is fine, especially if people understand how it works. And I think, you scale and you grow from there. And as the amount of assets in a system increases and the Lindy effect takes hold and that code has been running safely, that's absolutely when and why and how you start to remove privileged access.
And I know there's no answer to this, but what time frame would you put around that? Like, when do you start considering, a set of contracts to be not ready for obviously complete decentralization, but to have had enough really smart eyes, enough attempts, and kind of a level of seasonality to them in the market? Is that 3 months? Is that 6 months? Is that a year? Is that a month? Like, where do you guys stand on that side of the fence?
I think we should put a rule of thumb around this, Chris. I think we can do that, right? Like, I don't know if you can measure it, but I feel like 3 months with like $100 million in something is like, I feel like that's a pretty good sanity check that this surface area, the attack area, is clear. Robert, what do you think?
Well, I think that's pretty good. I think the reason why it's good is because it has to be sitting out there long enough for black hats to be motivated to act. Something could be on mainnet for 2 years with $100,000 and it's not going to catch anybody's attention, right? You're not going to have people attempting to break into it. But I actually think the standards go up, right? When there was 5 DeFi applications, right, Compound being one of 5, there was only 5 places to look. If you were a black hat, you'd spend a week on Compound, a week on DYDX, a week on Dharma, whatever, a week on MakerDAO, right? And everyone did. Like, I know a lot of people that tried to break those respective systems. And, you were more likely to sort of catch the attention of white hat, gray hat, and black hat folks. Now there's just so many projects that the likelihood of being noticed is lower, right, in a lot of ways. And so I do think it's a function of, time spent with a large amount of assets, but I think the standards have gone up. 2 years ago, I would have said, having more than $1 million in it, in a couple months, that's the test of time. I'm not going to poke fun at a particular team, but there was a particular team that got hacked like 3 times, right? And it happened like a week after their assets went from like 1 million to like 15 million. As soon as they started growing, that's when, it clearly pulled black hats, out of the woodwork to like take a look, right? And immediately after they started growing is when like problems started happening. They were on mainnet for a long time prior to that, right? With no issues, even though the same issues and bugs and all that would have probably been there. So, it is a function of the market dynamics. I do think there's a limited number of, malicious actors in the space, and I think their attention is limited. I think it includes individuals and nation states. I mean, I'm pretty sure, some of the more corrupt and evil nation states actually do play in that arena, North Korea in particular. But, as a rule of thumb, yeah, sure, $100 million in 3 months, you're probably fine, assuming that there's no additional changes to the code base. And every additional change to the code base either needs to be small and well understood or be audited thoroughly, right? If that code base is changing, you have to reset the clock.
And I guess actually, Robert, there's a whole other thing to talk about there, which is this tension between the nature of audits, which almost function like a waterfall style development structure where you like do a whole bunch of work and then get this whole thing audited, versus like the iterative agile development structure that like teams prefer. And this is another thing that I think DeFi is really tough with, because the audit concept is like this slow, chunky, clunky, audit constrained thing, whereas people want to develop in an agile, rapid, quick and easy way. And I don't know, I'd actually be curious what's Compound's approach on that.
Yeah, I mean, at Compound, we always move really slow. It sucks, right? It sucks to have a 6-month build process, where, our process has always been, probably 2 months of design, where you're really just talking out things, starting to spec them out, really just arguing and debating and like analyzing how things should work, 2 months or so of building. And then it's on testnet, and it's about 2 months getting ready for launch, right? That's a 6-month cycle. If you look at traditional software, startups, 6 months would sound mind-numbingly horrible to ship code, right? Like, everyone who's coming out of Silicon Valley startups, they have 1-week sprints where sometimes in a week you're pushing to mainnet 4 times. And it's just a completely different pace and scope to do things in what I would call doing them correctly. Other teams in the space don't spend 6 months for major releases. They do them in 4 weeks, right? Or 2 weeks, or whatever. But, our process has always been extremely long. And it's also, yes, as a product of us starting in 2017 when nobody trusted smart contracts at all. But it's a long process, to get to mainnet, things have to be beaten up a bit.
So we're actually going to try something, Robert. Oh, go ahead, Chris. Sorry.
Yeah, no, I was just going to say, we've been trying to figure out at BADGER kind of what that in between is. And like, there's only so much that we could speak to, because you talk about a 6-month, release cycle, and we've only been around 3 months. So it's like, how much can we actually, develop there? But, the approach that we've taken is kind of a combo, because, that's another big challenge right now, is the auditor and the auditing landscape. It's become unbelievably difficult to nail down high quality auditors. It's like, a three or 4 month wait and like $200,000 to be able to nail them down. And then by the time like you're there, you have a whole slew of new contracts and new things that you're trying to bring to market. And I think that's, Rob, to your point, a little bit of the test and prod type mentality in motion. But, nonetheless, on our side, we obviously have the internal reviews and the build process, but we built out a smart contract advisory board that's, internal / external, but, they're compensated through BADGER, and all they do is review new code as we build it and kind of as it progresses. And along with, like, if we're looking to do an integration, like with UMA, for example, that board will review it amongst the internal team as well. And then we have, an external auditing group. We've kind of been lucky to nail down a really solid one on a monthly basis. But then we have them kind of just it's just like this rolling thing. They're constantly always reviewing new things as the board kind of finishes their review, as the internal team finishes their review. And then, with our network of other groups in the space, community-oriented projects in the space, you kind of have this peer review process that we help each other out with. And, again, just, review the code and run tests and do whatever is necessary to determine the quality of that and any potential gaps. But, that's what we've done to be able to enable us to kind of move faster. At the same time, to be able to, I think the difference here too is like, we tend to take the approach of build off of an existing foundation rather than the floor up and the ground up. So even the things that we're bringing to market is more around, integrating how they work with our system versus building a new system, if that makes sense. So it obviously requires different risk parameters.
Yeah, absolutely. I mean, that makes total sense, Chris.
Mm-hmm. Yeah, Chris. So we're actually trying something where we're moving towards a retainer model with a top auditor, and we're trying to do this to do what you're trying to do too, which is, can we have an established code base that's thoroughly been audited? and then have an auditor on retainer review well-encapsulated pull requests that are changes to our system to let us actually attempt to make forward progress on something that doesn't look like a 6-month review cycle. But it's hard, man. And I kind of want, it's one of the things I'd like the DeFi space to move towards, and the audit space to move towards too, is figuring out a way to do these audits on an ongoing basis rather than this waterfall structure that I think slows things down. And then because it slows things down, I think it actually, people skip out on audits and it makes the space less secure.
Yeah, it's the audit situation. Like, Emiliano, he's been working on something called Review DAO, which is more of like a peer review type activity, which I think is a really interesting concept. But this is just going to be forced to evolve now, just because it's just they're way too tapped out auditors, and it becomes too difficult for new protocols to even be able to get their stuff reviewed. So they're kind of forced to, in some instances, degen it, right? And that's not good for the space as a whole either. And I think we're going to see a lot more protocols come together from a peer review perspective, but also like to help secure funding or like almost pool funding for different type of general good for the community and good for the the DeFi ecosystem type stuff. Like even if it's crowdfunding for large bug bounties across any smart contract, or even bug bounties in general. Like we started working with a group called ImmuneFi. It must have been like a month and a half ago, and we put a $500,000 bounty on our critical vulnerabilities. And he said, listen, like we'd rather pay out $500,000 or more than lose $50 million of users' funds. Or at the time there was like $300 or $400 million of users' funds in there. So like the bug bounty space, the peer review and like crowdsourced protection, that's just going to be forced to grow tremendously, which I think overall would be good for the space.
Like, Chris, that's actually a kind of interesting idea. This like peer review. Like imagine we had a group of projects all pool together and review each other's pull requests, review each other's code, and maybe we all contribute our own project tokens that could get slashed if we fuck up. There's something kind of cool there. I think there's an interesting idea there too that I like.
I agree. I think it's going to evolve tremendously. It's like I said, it's forced to, just because of the state of the market. So we're seeing some cool stuff come out, which I'm excited about.
Well, everything in crypto is an experiment, right? So all the ways that people organize and, create is evolving. And so it'll be interesting to see if there's different standards that emerge and, experiments that are successful and like change the way people think about this stuff.
That's for sure. Well, talking about change, I'd like to hear some updates about your guys' project. So, Rob, I know you guys had a pretty exciting announcement today, but what's going on with Gateway?
Yeah, so earlier today we announced and launched the testnet for Gateway, which was based on a white paper we wrote called Compound Chain. But it's basically a standalone chain called Gateway that's meant to create one interest rate with assets from many different blockchains. So you can sort of imagine it connecting to Ethereum and having Ethereum assets supported, and connecting to Polkadot and having Polkadot assets supported, and connecting to Solana and having Solana assets supported, and connecting to Binance Chain and having Binance Chain assets. And all of these can be used in one sort of like interest rate market that looks and feels and works like Compound. And it allows you to use an asset from one blockchain to borrow an asset on another blockchain. It's a pretty simple and elegant sort of idea. And we think it's like a really useful way of sort of bridging different blockchains together in a way that's not like making a wrapped token on another blockchain or like creating like a shadow token on another blockchain. So instead of having like wrapped ETH on 4 different blockchains, having a system where you can basically use real ETH and borrow other assets and, transfer value between blockchains easily. And there's a lot of advantages to this, instead of, trying to like wrap tokens and have them on this random side chain and try to port value. For every second that assets are on Gateway, they're earning interest, and you can actually use them to borrow other assets. And assets sitting on this sort of, bridge chain are delightful. They're not annoying. They're not high cost. You're not like, moving between chains is like, a pain in the ass. Ideally, moving between chains is as delightful as supplying assets to Compound, where you're earning interest. You can transfer those balances to other users or other contracts or your friends or whatever. And, all of the assets in Compound are transferable and portable for hundredths of a cent, not extremely expensive amounts of money. So one day, soon, this will launch. Right now we're in a testing phase where you can play around with, the system. You can play around with Ethereum assets. There's no other connected blockchains yet, but it's running as a proof of concept and a prototype. You can play around with it right now. If you go to compound.cash, click on the link that says dashboard and maybe the link that says dashboard guide, which teaches you what to do. But it's a working system. It's a prototype. It's alpha. This is one of the, examples of how we like to ship code. As soon as there's a testnet, we like to ship it. We don't like build something, wait for it to be ready for production and ship to production. Like, we're meant to have a long testnet process for people to poke holes, find issues, find the flaws, find the warts, find things that could be more efficient, better, faster, cleaner, different, and use it as an opportunity to polish, perfect, and improve before shipping to mainnet and handling users' assets. So today is the testnet release. If you remember the sort of timelines I laid out before, where there's sort of 2 months of, design, 2 months of building, and 2 months of prep before launch. We just launched a testnet today, and so it's probably 2 to 3 months before the system goes to mainnet. But it's a big, opening day in a lot of ways that introduces the next phase of building. And from here, the community can start to build what we're calling starports on other blockchains. A starport is sort of like a contract used to upload assets to Gateway and down from Gateway to that blockchain. And so now we can start building starports on other blockchains besides Ethereum. We can start, testing the system with validators. Validators are going to make a lot of money by running the validation process for Gateway. And we're going to beat up and test the system in a lot of ways. We're going to stress it. We're going to run scenarios. We're going to try to break it. We're going to try to come up with all the fail scenarios for it before it goes to mainnet. So today was awesome. I recommend anyone here who's bored, go to compound.cash and learn about Gateway.
So Rob, it's like, it's a really, really elegant design. I agree with that wholeheartedly. So like, if I'm going to ask the annoying question, what do you think, what's your biggest fear about it? What's your current biggest anxiety? Or do you think it's just going to work?
Yeah, well, the biggest issue right now is, this is similar to when we launched the Compound in 2018. And I was like, it might be a long time before this is necessary, right? It still might be a long time before there's DeFi really on many different blockchains, or there's good assets on many different blockchains. What's nice about this is it really future-proofs the Compound ecosystem. It gives like a tool to build one market that sort of spans the markets running on Ethereum right now with other blockchains, but it might be a year before it's really even necessary. Things will continue to run on Ethereum. They'll continue to be important and useful and, continue to be an integral part of the sort of DeFi ecosystem. And Compound, might have put a lot of effort into Gateway, which people don't see being used for a couple months. It might be a year before people are like, wow, this is necessary and useful. And, my biggest fear is that it takes a while before there's the real use cases, really awesome assets living on other blockchains, DeFi growing in other blockchains to make it necessary to bridge them in this way.
Cool. That sounds great, man.
So Rob, tell me about kind of the composability across these different chains. Like, Are you primarily going to look at EVM compatible changes from a tooling perspective to start? Like, how are you guys thinking about that?
Yeah, what's really cool is it's actually up to the community entirely on what chains come next and how. So, the chain is governed by comp token holders in a very similar manner to how the Compound protocol is governed. So right now, it's not really up to me, what happens to the Compound protocol. The community can kind of do whatever it wants with it without needing my permission, right? Without needing my input. And it's going to function very similarly for Gateway. So if the community wants to build a starport on, Polkadot, they can. If they want to build a starport on Binance chain, they can. If they want to build one on Celo, they can. If they want to, whatever. If they want to build one on Tron, they can. And it's up to the community. And maybe the, Solana community wants to build the Compound Gateway starport on Solana. Great, right? The development and upgrading of this system is like open to others to build. And so I'm actually curious and just excited to see where folks want to take this, where, development energy gets concentrated. And I'm sort of, once we start to get the test net running smoothly and move towards production, I'm going to like sit back and just watch without an opinion on where it's supposed to go next.
Yeah, but with that being said, like without imposing your will.
Yeah, what is your opinion, Robert?
How do you see it evolving? Like even in the community's hands with all their types of with their ability to make different decisions. Like how do you see it evolving?
Yeah, I mean the way I see it evolving is wherever really big valuable assets are, that's where it should expand, right? So like if Solana has a bunch of like $1 billion assets on it, that would be a great chain to expand to and integrate, right? It would be great to build one cohesive interest rate market that spans all the popular Ethereum assets we have with a couple other $1 billion assets, right? If it's a chain like Tezos, yes, you could absolutely create a starport on it today, and maybe it's amazing to connect Ethereum assets with Tezos, but there's not really any other tokens that have large volume market cap and liquidity. So it might be like a really high energy, low output endeavor, and maybe that's a bad chain. So I actually think like the best part is going to be waiting a couple months and seeing which chains start to get assets and why. There's no rush to integrate additional chains. I actually think this process is going to take a long time to play out, much longer than people think. My gut is that there's probably going to be a couple big assets on Polkadot. There's probably going to be a couple big assets on ledgers we don't even anticipate yet. Like, people could connect Gateway to Flow, the NFT blockchain. There's all sorts of crazy permutations in there. So I actually think the community should take it a little bit slow and just see where the assets are that need to be integrated. One day there's going to be U.S. treasuries on some blockchain. I don't know if, the U.S. Treasury or investment banks or whatever are going to issue those tokens on Ethereum. They might make their own blockchain, right? They might use a special purpose one for an industry consortium. They might issue them on Tezos. Who knows, right? But wherever the big assets start to pop up is where I think Gateway should build starports.
Rob, like random kind of technical question. Does it make sense for a starport to be built on Ethereum layer 2 or not?
You actually could. So you can basically build one anywhere that has smart contracts. So you could build a starport on Optimism, one day. You can build a starport on F2. Even for traversing, between different Ethereum, segments, you could build those starports. And that could actually be like a really cool and logical first step as well.
And I guess actually it'd be kind of cool because if you did do that, so let's say you had USDC on Optimism versus USDC on Ethereum layer 1. Could they have different interest rates?
Yes, but within Gateway, they would be two different assets. It would be like Optimism USDC and Ethereum USDC, and they might have different interest rates. And
then somebody would arb them, right?
Yeah,
if they did.
A savvy user might just provide that liquidity to sort of draw the capital between chains as needed. The really cool thing about Gateway versus how Compound works today, and this is one of the things that like people sort of discover as they start to go into the docs and into the test net to experience, the risk and liquidity models on Gateway are much more advanced than the Compound protocol today. And so stable coins will be extremely efficient collateral to borrow other stable coins. Like, you know, about 100 times more efficient than Compound protocol today. So it's going to open up crazy use cases like, you know, borrowing USDC on Optimism using Ethereum USDC at like, you know, 100x leverage and making a fortune for small interest rate differentials.
So does that kind of end up looking like a curve competitor in a weird way?
In a weird way, yes. Yeah, for sure.
Cool. How does this play into the Bitcoin network? Would you be able to build a starport for the Bitcoin network?
You know, it's possible that like Lightning gets advanced enough at some point to support, you know, contracts, something like that. Absolutely. Like, you know, on Bitcoin, you know, just the L1 blockchain, I don't necessarily think like it's easy. You know, it's possible that maybe with some combination of like, you know, time lock hashes and stuff, you can do it. Maybe, you know, it would require some real R&D, but the answer is possibly.
Mm-hmm. But you know, when I think about billion-dollar assets, right? Like, I see the first, like, you know, just look at other chains and what happens. So, you know, what are some of the biggest assets on, I don't know, Tron? Well, it's USDT, and you know the stable coins and Bitcoin for the most part. And you're looking at other chains, and they have this fragmented. They fragmented, you know, asset diversification across chains, but it's kind of all the same assets. It's just what are the incentives on those chains to bring them there and use them. So do you see like the first iteration when there is multiple chains? Like as you suggested, it could be a long time, which I agree with. But do you see it really just being like, okay, we're going to bring Bitcoin from Polkadot and Bitcoin from Solana and Bitcoin from ETH, and you know, and then there's just kind of this, you know, interesting, you know, ARB money market in between that allows people to do different types of, you know, financial activities that they couldn't do before in a single asset world. I mean, single chain world.
Yeah, the answer is yes. It'll be interesting to see how it plays out. There's a lot of unknowns still, but you know, I think if you look a year forward, there's going to be all sorts of funky things like that.
Yeah, that's cool stuff. I dig it, man. Congrats on getting to testnet. That's a big advancement. Good for you.
Thank you. Yeah, testnet is still a big journey to mainnet. You know, we're not celebrating too quickly, but it feels really good to sort of get this out there to the point where people can start to play around with it.
I like the name. I like Cash. That's really cool. That was a good idea.
Yeah, it's meant to be an incredibly generic. I don't even call it a stable coin. A completely generic unit of account.
Is there going to be the, I would assume no, but I don't know. Would there be the level of scrutiny and rigorous kind of standards for assets being able to port to, or even, you know, if there was a starport, be able to come into this, you know, this universal money market?
Yeah, so the answer is these standards are actually going to be lower than Compound protocol on Ethereum today by a lot. This is actually a good thing. So, you know, one of the sort of features out of the gate that Gateway is going to support is sort of what we're calling supply caps, where it's like limiting how much of an asset can be used on the chain. And so this is something that we sort of like for a long time wanted to build into Compound, but, you know, the original code base is a little bit old. And so it's a little bit unwieldy to build this in. But it's going to make it easy to say, yeah, we can take almost any asset, maybe only $5 million of it, see how the market grows, right? But just take small amounts of many assets, especially because, you know, the ability to do computations on Gateway is like so much better than the ability to do computations on Ethereum and Solidity, right? So it's going to allow just, a huge increase in throughput. So, small assets are welcome. We may as well have 1,000 small assets, right? None of which individually are big enough to pose a risk. And collectively, there's enough diversification that there's no real concerns. But it could support hundreds of assets in a way that Compound today just can't.
And then, Robert, the supply caps would be increased by governance, by comp token holder governance. Is that the idea?
Yeah. Comp token holders control literally every single parameter of the chain. So just like they do proposals today to change, parameters, they're going to do the exact same thing.
Well, we talked about this earlier, kind of like a tighter grip on the control of the system as time goes on and moving more towards decentralization. I think this could be a little different just because of the nature of how long comp's been in market, but this is all new tech. So what's the plan around that? Like, is there going to be stop gates that the team manages, that the team controls? Like, how's that going to look?
No, there's going to be no functions that, our team has that the validators don't, right? We're not going to be a privileged party at all when it launches. I think the best way to sort of launch this safely is to put real limits on the size of the markets, limit each market to $5 million of assets where, you don't have any privileged access or controls, but the markets are small enough that if there is a disaster, you're not vaporizing $1 billion, you're vaporizing like 10 million, something small enough that honestly, comp token holders have enough resources to be able to handle a small disaster, right? Just not $1 billion disaster.
Interesting. Would you argue that kind of goes against what you were saying earlier though, Rob? Around that, because it's new tech. It's you're going through this strenuous 6-month process as you usually do, except this is much less tested than your existing contracts.
Yeah, we want this one to be battle tested before it launches. When it launches, to have limitations in place, which Compound never did. Right? There's never really limitations on the size of the market, and prove the Lindy effect over time. And as it starts to get proven out, start to raise those limits and let the assets start to scale.
I think that makes sense, though, given where you're at now, like having a different approach to launching this versus how you launched comp. Right, Rob?
Right. And there's a couple other differences. At this point, when we originally launched, Compound, there was only our team, right? And so it made a lot of sense for only our team to sort of have the emergency buttons. When we launch something like this, you don't want a blockchain to have emergency buttons at the end of the day, right? You want a blockchain to have really no ability for anybody, to tamper with it. And so I think that has to trump, sort of short-term security concerns.
Yeah.
Well, I'm looking forward to playing around with it. That's for sure.
Yeah. Well, I imagine by Friday of this week, it's going to get smooth and fun to play around with. We really did ship a pretty alpha prototype of it today. So you can play around with it right now. There might be a couple of quirks. It might be a little unwieldy, but by Friday of this week, it's going to be pretty smooth.
Sweet, man. I dig it. Well, Hart, let me ask you, I want to get a feel for what's going on in UMA land. I know we got a couple things cooking, but what's been the latest and greatest over there?
Yeah, we do have shit cooking, Chris, which is cool. The latest and greatest is just sort of a realization that there's this primitive of taking an ERC20 asset as collateral and then designing a payout function that can be really arbitrary to then create a synthetic token, a derivative token. And I think we're kind of actually realizing that this concept is ludicrously powerful, that we can do actually a lot of ideas here. And so, Chris, like what we're doing with BADGER, right, is this idea of taking BADGER Vault tokens and using them as collateral, and then defining a payout token where we're going to create a synthetic token that's worth $1 of that collateral at some expiry date. And all of a sudden, we've just created a zero coupon bond and kind of like a stable asset on one of these BADGER tokens. which is like pretty cool because now we're taking what is otherwise a relatively illiquid and sort of unproductive asset. It's being productive because the Badger token itself is like it's a bunch of underlying things doing interesting stuff. But we're now doing another layer of taking this asset that's relatively illiquid and making it into something useful, which is kind of cool. It's like alchemy, right? And then we realized recently we can use the exact same primitive, this synthetic token primitive, to create call options on any ERC20 asset. So we're actually going to publish something about this tomorrow, which I think is wild. And then we've got this whole idea of KPI options. So we can create options that will pay out a project's token based on any KPI. And then we've got a whole design for perpetual synthetic tokens that we're pushing out. We're going to test next week. So there's just a whole bunch of shit going on where we realized we can do this alchemy of transforming ERC20 collateral into any arbitrary synthetic token, and there's a hell of a lot we can do there.
Yeah, it's, there was an article that a community member wrote from Badger just around, and we didn't even think about it as much about this, but like you have this explosion of capital going into new protocols, into protocols in general, and it's being productive, as you said, but it's relatively liquid. Like just in general, most assets, like, you take, let's just use tokenized Bitcoin, for example. Like you can take it to Aave, you can take it to Compound, you can take it to Maker, you can go to Sushi or Curve or Uniswap. But once you deposit there, like there's definitely more use cases for C and A tokens or CWBTC and AWBTC. But for the most part, it becomes illiquid, right?
Yeah.
And that's gonna, that really, it should start to become clear for the community and the ecosystem as a whole that it's because that's like as primitive as it gets, right? Like there's going to be layers on top of layers on top of layers. And I believe, the synthetic protocols like UMA are really going to help unlock that illiquid value. And more importantly, it's going to help the greater DeFi ecosystem because it's going to give them the ability, or give users the ability, to continue on their journey and continue participating, right? Because you've been able to unlock that at different stages. And I couldn't be more fired up about, just that concept in general. Forget like UMA, forget Badger, just in general, like what that's going to do for the space. I think it's just going to be massive.
Yeah, well, Chris, this is something you and I have talked about a bunch that I think is really like just a really smart insight or observation on your part, which is this idea that you want to be a middle money Lego in this stack of Lego blocks. You want to keep stacking them, and if you're a project with a token or whatever else, you want that collateral to be in the middle of this Lego stack, because not only does it demonstrate that you're being used to build something, right? So if like a Badger Vault collateral is actually stacked in the middle of this Lego stack and then is being used to create a zero coupon bond or being used as collateral for something else or whatever else it might be, that's just good for Badger. That just means that Vault collateral is useful. And for the protocol's perspective, it also creates stickier assets. It means your assets aren't going anywhere. So I do think that this process of alchemy of taking ERC20 assets and then converting them into something else, like that is at one level what Compound does, and Gateway's doing it now across chain, right? But this idea of, I got this one thing, I want to swap it for this other thing, and you just keep going on your journey, as you call it. That's freaking powerful, man. I think that's really cool.
Yeah, I obviously agree with you. I'm interested to, like, you guys obviously can't build all these cool things that you're talking about. Like, how are you guys connecting with different, like, have you seen just naturally with so many new projects in the space, and also some of the newer projects from mid last year maturing a little more, and getting rid of some of the ones that didn't kind of survive that up and down swing, but Like, how are you guys collaborating with different developers and different teams to have them, because you can't build like all these different things. Like, how are you guys looking at that way?
Yeah, we've been playing with this concept of developer mining that I know BADGER and you are also interested in. And it's this idea of taking the incentive structures that Robert and Compound led with around yield farming and being like, okay, that was incredibly useful for driving liquidity into various DeFi protocols. What if we can try to use the similar concepts to instead incentivize another really extremely important component, which is developers? And the difference here is we're trying to position UMA as a developer infrastructure itself. So can we use similar concepts to incentivize developers to build on our infrastructure and frankly reward them for their own ingenuity and their own like good ideas? Answer turns out we can, and this has been happening pretty quietly, but we've had like a massive, like each week we have about 10 new ideas that get proposed in our governance system now from developers that want to build various synthetic tokens. And it's actually been a really powerful concept to try to reward builders using our infrastructure based on a measurable metric of like their own ideas popularity.
Hell yeah.
Hell yeah is right. Yeah, I think, yeah, I think that's, you know, that's one of the challenges, right? Like, I think people are experiencing these challenges across a variety of different areas. One, it's like, you know, if talented developers can build something and like Rob was saying, like you can go to market in a week or two with a couple people, and you know, in some instances, like turn that into millions of dollars, like in the same short time frame. Like the opportunity cost of not doing that as a talented developer versus kind of working with or working on existing protocols or in collaboration with those protocols. It even spans like hiring folks, right? Like a lot of people talk about just the crunch in hiring really talented developers in our space. You know, I think we can all attest to it. But just in general, having the right incentives are absolutely critical. And those incentives need to speak to obviously compensation, but they also need to speak to shared ownership. Because why would I put my blood, sweat, and tears into building something and then not have a say in the thing that I build? Like that really doesn't jive, you know, and that's where the power of governance tokens, when, you know, implemented properly, can actually bridge that gap. Because if you have different type of incentive programs that based on tangible things, like being able to bring revenue to a protocol because of the product that you're building with that protocol or for that protocol, whatever it may be, and then in turn earning a percentage of tokens or tokens in general that allow you to then govern said product, that keeps that skin in the game. That keeps that shared ownership, and that's necessary. To really delineate between, hey, I'm just going to go work for someone and work for a company, excuse me, and build some cool shit, or like, you know, just build my own shit and just degen it and, you know, bring it to market quickly, right?
I mean, Chris, like 100%, man, and you're like the king of this in some ways. But like go back through how we even got here. You know, stock options have been around for a long time as a way to incentivize an employee of a company to sort of be aligned with the success of that company. But like that's just within the walls of that company. We're now creating these incentive structures that are actually like grassroots community driven. And BADGER is this unbelievable example of building a community that did not exist 6 months ago. Maybe 6 months ago, Chris, you can tell me better. It didn't exist 8 months ago, right? You went from zero to something massive because you were able to align incentives and because you were able to give the community ownership in the thing they're building. And like the evidence is like in your own protocol about how successful that is and how many people you can get involved and the degree of energy that happens in that. And that's fucking wild, man. It's like unbelievably cool that that's possible with this weird crypto thing that lets us build and design incentive structures in ways we were never able to before.
You know what's funny to that point, Hart, and this ties it all together. Rob, this must have been maybe October. I'd say maybe the latest November. And we were talking about Badger, and you said something like, you know, you're going to need a lot of people to build that out, man. Like, like something like that. Like, what you're talking about is pretty crazy. Like, you're going to need a lot of people. And, you know, we just did our grants program for the month today. And I just posted it like right before we jumped on this. And it's fucking nuts, dude. There's 58 contributors, all earning Badger every month. And 98% of them have no legal name associated with their contribution. Right?
That's
like it's crazy. It's like so nuts. And it to your point, Hart, it starts from, you know, it really just starts from people having that aligned. I believe, honestly, I think a lot of it, and this is where I think some folks miss the boat. It's not just about like giving that shared ownership and you know, being really inclusive and working very closely around important decisions with this community early on. It's also about having a shared value and belief system, right? And that shared value and belief system, almost shared mission. Like for us, it's obviously, you know, Bitcoin and bringing Bitcoin to open finance. But, you know, even before we started, you know, we identified 32,000 wallet addresses that either participated in decentralized governance over the last couple of years, used Bitcoin and DeFi over the last couple of years, including, you know, Compound, Baker, and Balancer, and all these types of things, and also supported public goods. And, you know, between these addresses, these are the ones that said, okay, hey, come and claim your Badger. And from day one, it was people that had that shared belief system. And I think that's extremely critical when trying to build out a community, especially if the community genuinely is going to be leading whatever you're building, you know?
Yeah, Chris, every time we talk, man, I tell you this, and I just mean it. It's like you have fucking nailed, I think, two extremely important things. You've executed on it exceptionally well. One is a clear mission that actually resonates with people, which is, okay, let's bring Bitcoin to DeFi. Clear, simple mission. I'll be honest, when you were, you know, talking about this, I didn't think it'd be that big a deal. I was wrong. There's people that care about this, and a lot of them, right? And then the other thing is you just authentically did it community first from day one. You know, you're not in it to like make a bunch of money for yourself or whatever else. You're in it to build this thing with the community and have the community be successful. And it shows. And those two things like just fucking work. It's wild. And yeah, I don't know, man. It's just cool.
Sure is, man. It's fun. Well, guys, we're at 90 minutes. I feel like at the 90-minute mark, I tend to get a little drowsy and a little beat up. What do you guys think about opening the floor a bit, having a few people jump up, and then we'll wrap up after that? What do you think?
Let's do it.
All righty. All right, we got Chad and Tom. Chad from Rune, Tom from Power Trade, if I'm not mistaken.
What's up, guys?
What's up, buddy?
What's up, Tom?
Hart, I had a question for you.
Yeah.
When you mentioned that when you started UMA, you wanted to create this like DeFi margin system, which sounded like that vision had a much bigger scope than where UMA is today, which is normal for a startup. You have to start something achievable and build yourself up to that vision. I'm wondering, one thing I see missing in DeFi in general is cross margining. So if you are, say, you're minting a position in UMA, you're maybe you're minting some Y dollars with Bitcoin collateral, and then you're minting Y dollars with ETH collateral. Those positions themselves are not cross-margined with each other, and then you might be having other positions, and they're all kind of like isolated margin, right?
Yep.
Do you see a way to solve that cross-margining problem?
Yes. I think we just aren't quite there yet, but we're going to probably get there fast. So just actually, so for everybody to understand what Tom's talking about, if I have to lock up a lot of capital to mint asset A, and I have to lock up other capital to mint asset B, but if assets A and B are offsetting, I really shouldn't have to lock up capital on both sides to mint them. And I think that there's a lot to do here, all about making things more capital efficient. And I just think that's the way DeFi is going to evolve. I think like kind of our strategy or structure is to put as much of the logic monitoring this off chain as possible. A general theme in kind of the way we look at the world is that the rules of the game should be written on the blockchain, but monitoring whether those rules are actually being followed or not should all be done off chain, where it's that much cheaper to do. And I think we're just like on the path to getting there. I think it's going to happen fast. And I think stuff is going to become increasingly more capital efficient, both with synthetic assets and then with just cross margining and like all these just DeFi products in general.
Cool. So not ready to talk about specifics?
Yeah, I don't have any, like, I think the biggest specific that I'm interested in that's in the vein of what you're talking about is how to make synthetic assets, the liquidity provision of synthetic assets, more capital efficient. So right now on kind of all these synthetic programs or products, ours included, you have people that you have the token holders which buy the synthetic asset. So fine, that's all well and good. But then you have minters who are creating the synthetic assets, and then liquidity providers who are often minting synthetic assets and then putting it in the AMM pool. And there's actually a lot of capital inefficiency here, where the people minting the assets have to over collateralize them, and then they put them in an AMM pool that there's actually not a lot of risk there. The protocol is like way over collateralized if you kind of look at it from that lens. And I think that one of the things that I'm really curious about is looking at how to increase the capital efficiency by effectively combining the minter and liquidity provider roles into something that would let you have a much more capital efficient structure for that side of the trade.
That would be very interesting. The new perps rollout could be interesting as well. You could have 30% collateralized positions, something like that. With
totally,
if you're just paying the funding together. Yeah.
It goes back to this idea of like, if we do this synthetic token alchemy where we take an ERC20 asset and we have a payout function to create another ERC20 asset, there's nothing wrong if the collateral asset, that ERC20 asset, is something weird, right? It could be another synthetic. You could do weird recursive loops of what that thing is in a way that I think could be extremely capital efficient and really, really interesting.
Indeed. And I just want to give a shout out to, both the Compound team and the UMA team. In what year is this? 2021. In 2019, everybody was still pretty skeptical about whether DeFi was going to work. I mean, other than people that were like deep in DeFi, and everyone, there was this kind of like realization, I think, within the DeFi community that governance tokens were about to be a thing, but the rest of the crypto community was still highly skeptical. And so there was two key events in my mind that really kicked off the DeFi boom and having people see the value here. And the first one was UMA creating a Uniswap pool to launch their token. And it was kind of like the first major time that Uniswap was used for an initial listing. And so that was, I think, a very important event that made everybody go, hey, like something's happening over here. What is going on? And then the second one was Compound launching the governance token. And I think that kind of made everyone realize, like, hey, these governance tokens are actually valuable and they're useful and like they have a role in the ecosystem. So yeah, kudos to both of you. In my mind, you guys kind of kicked off the whole DeFi boom cycle and made a lot of people realize that we're building some valuable shit here.
Thanks, Tom. Appreciate it.
Yeah, thanks, Tom. That's awfully nice.
Chad, how goes it, my friend?
Hey, Chris, man, how's it going? Good to talk to you again. Yeah. Thanks, Chris, for moderating. This has actually been like a really great conversation. I've been learning a lot, just kind of do some house chores and listen to you guys talk about your projects and stuff. It's been actually been really educational. So I appreciate you guys spending the time to both Robert, Hart, and you, Chris. So first of all, thank you for that. My question I have is for Robert. It's out of curiosity. It sounds like Compound Gateway is predominantly geared towards EVMs of different sorts. I'm curious to understand what went into the decision to go after EVMs versus EVMs plus, other like POWs or what have you.
Yeah, that's a great question. And I think you're right. It really does focus on EVMs to start. And I think that's because, it's a system that's meant to, hopefully bridge different DeFi ecosystems. At least that's how we think about it. Compound's coming from, the early DeFi days, and we're sort of DeFi centric in a lot of ways. So, we're really looking at chains that have smart contracts on them that you might want to port liquidity to do other things with it. It's not a trading platform, it's really just a way of porting value. And so, for us, the sort of 80-20 rule and the lowest hanging fruit was, where can we build a starport using a smart contract or an EVM?
Yeah, I guess my first thought would be, my understanding, and you're welcome to correct me if I'm wrong, is one of the predominant use cases of something like a compound finance is to 3x long your position on, Ethereum or some other ERC20 token. And I'm quite confident that there's a lot of kind of people in the crypto community who want to use layer one Bitcoin loans for like not pegs or run BTC and what have you, but real layer one stuff. I have to assume that that's something that you guys are looking into or want to service or something like this.
I mean, it's a lot of work to actually support native Bitcoin. Yes, that would be amazing. This is not easy. Many teams have been working on it, and it is a Herculean task, so to speak. And so, I think the more logical place to start is probably the easier, lower hanging fruit.
Well, Chad,
yeah.
Herculean tasks, that's really what Rune's focused on, right? And Thor.
Robert's absolutely correct when he calls it a Herculean task. Connecting to a layer one Bitcoin, for example, is quite complicated for a whole host of reasons. There's economic concerns. There is complexities like reorgs and this kind of stuff. The Thorchain team kind of made it a vision from the get-go to have a requirements in terms of being able to bridge two particular chains, to be that requirement to be as narrow as possible or as little as possible. So in theory, the Thorchain network can connect to any layer one assets or even layer two. Hell, like it can do layer two to layer two if it really wanted to. When the Thorchain network launches, the second network at least, in a few weeks, it'll support 5 different chains. It'll be Bitcoin, Ethereum, Bitcoin Cash, Litecoin, and Binance. To Robert's point, our first network was just Binance only, and we chose Binance because it was a relatively easy chain to connect to. It has instant finality, for example, so you don't have to worry about reorgs or confirmation counts or any of these kind of complexities. And we felt that the Binance community really didn't have any DeFi. So there was a kind of a need to be filled there. And so we decided to launch the first kind of chaos net solely on Binance to support that community and to prove the economics, prove the security, prove that all the economic assumptions that we've made work out beyond the audits and reviews and all these things that we went through, and actually test in real world conditions and make sure everything is as secure as we would like. And today we have, I think, close to $300 million TVL on that chain, and it's been going on for, I think, 5 months now, 6 months, something like this. Yeah, I'm hoping that we can move DeFi into a way that is chain agnostic, asset agnostic, doesn't know or care where you're coming from, whether it's Bitcoin, whether it's Litecoin, whether it's Dogecoin, Zcash, Monero, you name it. It all can be interfaced into DeFi applications that give you layer one connection to DeFi. So Thorchain's initial application is kind of like a Uniswap and exchanging assets through a CLP using a slip-based fee model. But there's no reason why we can't add something like what Compound's doing. I mean, Compound is like the first in total respect for the Compound team, what they've done. It's a fantastically well-developed, well-engineered smart contract. They've done excellent work. And that's the reason why this Thorchain can't do the same thing, but instead of just doing for Ethereum, you can do it for any chain. So you can provide capital as ETH or Dogecoin, and then get Bitcoin out on the other side of it, and get like a loan, and not only a loan, but actually potentially even a fixed rate loan, like an actual fixed rate loan. You are locked in for that time period of whatever your loan is, you get the time that you take it out. So there's really some great opportunity, and I'm really hoping that the larger community of DeFi kind of pushes in this direction of chain agnostic DeFi application that can service any chain, no matter where they're coming from. And I think a lot of things are happening in that way around the Cosmos ecosystem, as we're seeing more and more apps being developed in that ecosystem there, which is actually a really good model that they set over there. But yeah, it's interesting. And to be fair, Robert, please don't get me wrong. I actually really like Compound. I love what you guys are doing. You guys are doing an amazing work, amazing job. Total respect for you guys, the team, and your model you're talking about about taking it slower rather than faster. And we totally are with you 100% from that perspective. So you guys are doing great work.
Thanks, Chad. Appreciate that.
Grant, what's going on? Welcome.
Hey, what's going on? Yeah, thanks so much. It's been an awesome room. Great listening in. Had a question generally about, interoperability across chain. And I know, a couple of you guys are working on that, perhaps. Leshner, if you want to weigh in, I had a question that's kind of two-pronged. First was, you're thinking about Gateway. You're talking about how you're not going to take kind of the wrapped approach. You're going to have, legit ETH being exchanged on top of Gateway and through the starports. Could you expand a little bit on how that would be happening? And then also talk a little bit about, what projects you took inspiration from as you were thinking about Gateway in terms of past, implementations of cross-chain compatibility?
Sure, that's a great question. So for the first one, I would say, just start with the docs. I'd rather just jump to the second question, which is, what was the sort of thought process and inspiration for creating this? It kind of unfolded from the idea of saying, one, how can you make a compound that in a autonomous, decentralized fashion supports more than just Ethereum assets, where you have an interest rate market that's not limited to the 8 or 9 or 10 whatever assets that the protocol currently supports? How can you build a system that supports the real, and I'm putting that in air quotes that you can't see, the real version of other assets? So that's the first question that sort of evolved into it. And then the second was in terms of the actual bonding logic of how do you actually bond assets from one chain and basically bond them into a new system. That's at this point like starting to become sort of common technology, and we basically are just combining those two building blocks. Bonding an asset on an L1 to make it appear on the L2 with the logic and the sort of, business logic of what is a money market, to pass the assets back and forth between them. So that was sort of the thought process and the evolution that led to this.
Awesome. Thank you.
Yeah, thanks, Grant.
Mike, how goes it?
Hey guys, I had a question for Robert and Hart about regulation in DeFi. Like we see a lot of protocols like moving towards being meaningfully decentralized, partially as a mechanism to avoid being a target for regulation. But I guess like my concern, or like I wanted to know what your thoughts are. I was like, does that just move the target from the entities that they can't regulate that because they're not centralized to where does that move the target? Because ultimately, like these regulators are going to look to perform their job as regulators and prevent people from losing money in whatever means that people have to lose their money. So like I would think the nuclear option they have at the end of the day is to like outlaw individuals from participating in DeFi, which I would hope it wouldn't come to it. But like, is there some sort of happy medium where they can accomplish their goals as regulators, and also in a way that can allow these protocols to continue to flourish?
Robert, you want to go?
Yeah, I'll go. So, the key point that you just raised was prevent people from losing money. If you listen to what a lot of regulators are saying, that is their primary concern. That's pretty much always their primary concern. They want to prevent people from losing money. And there's a lot of ways that people lose money. I think this sort of has sort of shifted away from like, oh, are people creating securities that could lose people money by people speculating and getting swindled or hoodwinked by flashy sales pitches to lose all of their money, to what are these systems that are handling huge amounts of money and what keeps them safe? A lot of recent comments actually point towards a future in which regulators are more interested in communications around the safety of systems, how they work, whether or not they're audited, how the code is controlled, and preventing the physical loss of funds, not through, deception, so to speak, but through, error. And I actually do think that will be the future frontier of the intersection between DeFi and regulation potentially, where regulators are literally analyzing how different autonomous protocols function, how they're built, how they're run, how they're maintained, and making sure that they're held to standards that protect user funds from getting vaporized or stolen. And I actually see that as like sort of like a best case scenario in a lot of ways, where the regulators are concerned about making sure that users are protected. And the scary risk of the future is protecting users from things going poof. And so they're going to be concerned, and they're going to enforce standards that require everybody to sort of level up a bit to meet, institutional grade, finance grade systems, which frankly, most of the industry does not even come remotely close to meeting and remotely doesn't try. So I think that'll be where more of the focus goes.
Robert, this is music to my ears. I know that we talked a bit about the launch of your change today. And I suspect that this is part of why y'all chose Substrate for your own chain, because of this all boils down to governance and the ability to correct issues when they come up on chain. So I'm interested, obviously, congratulations on the launch of the testnet today, but beyond governance, obviously being a big part of it, what else went into your decision-making process in terms of launching your own chain?
Yeah. Thanks, Peter. I mean, the decision.
Full disclosure, I'm head of public affairs for Parity. Robert and I have chatted about this for a while, and obviously been working with Jared and the rest of your team on getting the thing up and running. So congrats.
So this is a layup then. So this is a layup question.
It's a layup, but also it ties in completely to the big part of why we all really realize the importance of governance. When you have a fiduciary responsibility, you can't say, "Oops, there's a bug," or "We can't fix an issue on chain."
Right, and that responsibility is over time becoming less one team and more a community of users and stakeholders and token holders and the systems and applications that integrate them, right? When it came to the decision of launching a new chain, it really came down to whether or not the sort of use case that we wanted could be met on its own. In a lot of ways, launching a chain was a last resort, not a first resort. And it was sort of due to us not wanting to wait for a couple of years for things in the ecosystem to mature. Compound's not meant to be a layer 2 scaling solution. It's really meant to create a market that natively supports many different blockchain assets. And the best way to accomplish that was to not wait for other things to exist, but to, hurry up the future and launch a system that could basically begin to connect chains in the way we wanted them to exist.
You know what I'd like to add here as it relates to governance, because it's been an interesting, journey for us, being it that, we're not a legal entity and we've never been a legal entity, and we manage billions of dollars. And we've gone through, some of these, we've been going through conversations, with legal groups, identifying potential frameworks for protocols like ours. And in the end of the day, I think, Rob, to your point, is that a potential future state where it's more around, how around the error side versus, just total, let's call it robbery, call it whatever you want, but deception. I think so, but I think that's much
We're
farther.
living this life right now already at parity with Polkadot, right? It's a decentralized protocol. Any hiccups in the network, bugs, major hacks, any fixes need to go through governance. We just can't push a pull request in the middle of the night because we have the keys to a GitHub repo. It has to go through the community. So I think we're living it in a sense.
Yeah, living it and how the regulators wrap their head around it are two different things, right, Peter?
I think they like that.
Yeah, but they don't know. They don't know their left arm from their right arm, right? When it comes to this stuff, right? So you're sitting in front of a judge. I
wouldn't say they're completely unsophisticated, but when it comes down to the nuance, especially base layer protocol governance is a little more understandable than DeFi protocol governance, where you're getting down to things that are a lot more, the users of the protocol want to position how the protocol is used in their benefit in a different way than sort of like a base layer protocol. So I totally get that.
Yeah, no, and the point that I was really just trying to make was, in the short term, the regulators are going to come after the lowest hanging fruit, obviously. And and when I say lowest hanging fruit, I mean, clear bad actors. And that's going to be pretty easy pickings for them. And I think a lot of the protocols, as we work through this kind of weird, hey, they're figuring this whole thing out, and we're moving towards what potentially, becomes this new world of DeFi, regulated DeFi, or DeFi in a world with regulations. I think a lot of protocols need to be putting up the right types of flags to say, hey, we are a good actor. We are doing everything we can as relates to security posture and all this type of stuff that ensures or at least giving their best attempt at preventing loss of user funds. And I think that in the short term, that's what we see. And then we eventually make our way, Rob, to the state that you discussed earlier as well.
But what's to prevent the bad actors from drawing the wrong kind of scrutiny on the era? So let's say there was an evil fork of Compound that voted in some sort of predatory lending practice or something along those lines, like a version of payday loan practice where the borrowers sign away their future paychecks from a DAO that they work for or something like that. If something like that could even exist, certainly that would draw scrutiny to And if that was something that was deployed on Ethereum, where would the regulators what could the regulators possibly do to regulate to prevent something like that from happening at that point?
Mike, in my opinion, the regulators, the like in air quotes, the regulators, right, will always can and will find somebody to go after, or at least they're not prepared to believe yet, and maybe ever, that there's not ultimately somebody that they can go after when there is a bad actor. Because the entire concept of there being a bad actor means that like somebody is the ringleader of doing this bad thing, and they'll go after them regardless of legal structure or whatever else, right? But I just agree with Chris's point. It's like if the bad actors are plentiful, they're going to be the obvious scams and bad shit. We all want the regulators to go after them. That's like the right thing for our community and our ecosystem. And you have credible projects doing their very best to follow the spirit of what the regulators are doing, and build cool shit.
Thanks, guys. Appreciate the answers.
Thank you, man.
No problem. Peter, did you want to add anything? And it doesn't look like anyone else has their hands up, so you have the last talking point if you like it.
No, I appreciate hearing more on the plans for compound chain. I I've been looking forward to seeing how everything was going to work out in terms of your plans long term. I'm excited for what's to come, and obviously, as the governance of such a chain expands, that's sort of in the wheelhouse of what we're excited about in terms of the future of this industry broadly. And I think DeFi has been at the cutting edge of, understanding how protocol level governance can be leveraged, and not to be scared of like this concept of like on-chain stakeholder driven governance as an attack vector, rather it being a place for value to be created broadly in this ecosystem for both the stakeholders and to help adoption. So looking forward to see what happens.
Yeah, likewise, same. And thanks for your organization building Substrate as a great tool that we've been able to sort of piggyback on in the same way that so many teams have piggybacked on the Compound code base.
All right, guys. Well, Rob, Hart, crew here. Appreciate you guys spending some time. That was really great conversation. Enjoyed it a lot.
Yeah, Chris, that was fun, man.
All righty.
Thank you all. Talk soon.
I think we wrap it up. Rob, Hart, crew, be well. Everybody, thanks for joining. And we'll talk soon.
Thanks, everybody. Go get them.
Go get them. Daddy DeFi over here. Go get him. Go break a leg, son.
I hope you're winning. Hope you're winning, son.
All right, everybody. Be well. Ciao.